Hello and welcome. You are joining us live once again for the Invest Lab, the epicenter for passionate people seeking a life of freedom, choice, and abundance. And it's been a minute since we have been here. We had
It's been a minute.
It's been a minute.
Been a minute.
We had some scheduling changes due to travel and seeing family. You know, life. Because we're humans. We have lives. And then last week you were a little ill, Gabby. You feeling better? Feeling better this week?
I'm all good, man. I am all good. Sorry,
Great,
finishing
awesome.
the fade.
And I got manned.
Oh, yeah. Yep, you did.
Any dieting tips? Shampoo Time has just asked us in the chat.
Oh, wow.
Hello all. Any dieting tips? Maybe we need to change the. Maybe we need to change the show. Maybe we should become a lifestyle channel as well. But for those of you who are here live, great to see you. Brett, Rich, Matthew, Matt, Shampoo Time, and all the rest of you. Great to see you here live. And if you are here live, let us know in the chat. We'd love to see you. I know that the schedule has been a little all over the place lately, but that's okay. We are ready to rock. Gabby, I know you said you're all good, but generally speaking, how are you? Excited for today? Excited for this episode?
I am. Are you excited?
Yes, because we have 4 interesting questions that we are going to tackle today. Now, sorry, I just saw Shampoo Time's follow up. So for those of you playing at home, Shampoo Time has asked, is any dieting tips? Yes, my wallet is very skinny. So you need to put your wallet on a bulk, Shampoo Time. Or maybe you're doing the right thing. Maybe you're allocating all of the capital. You shouldn't have fiat lying around in your wallet anyway. So if your wallet's skinny, that could be a good sign.
Could be a good thing.
I'm excited for today. We've got 4 questions. They're big questions, and we have a limited amount of time. So we are going to need to step on the gas to try and get through these because there's a lot of really good stuff in here. So should we just rip into it?
We should, yeah. And again, guys, I know a lot of you that join us live, but a lot of you that don't join us live that watch us in the replays on the weekend when you're walking around in the sun on the weekend. I was just in Australia. Sometimes there's sun. Sometimes there's sunshine. Sometimes it's nice. It's getting warmer. So if you're walking around doing that, listening to us, you may not know that we have the Investor Lab community as well, which is online. And this is really the place where we bring a lot of focus onto what questions you have as an investor in the current world that we are in. And really, that's how we generated these questions. I wanted to know what topics people wanted us to talk about a little bit more over the coming months. And we thought we would pull together 4 topics for this one because ultimately the real through line with this is how to position yourself in a world that's changing faster than ever. And these 4 questions are really kind of a good encapsulation, I think, of what people are thinking about right now as it relates to investing and setting themselves up for a really strong future. So
yes, good preamble.
All right,
actually, it was good.
Great. Okay. Question number 1. Are we ready, Goose?
We're ready. Yeah.
We're ready. Okay. Ta-da. Okay. So question number 1, I'm just going to read it out because we have it up on the screen. If you're listening, we do have it up on YouTube. So if you want to go check this out on YouTube and you can read along the question as well, but I'll read it out. So one thing I'm curious about is when the robots do take nearly all of the jobs, how are people paying rent and mortgages? Especially mortgages. Rent, I can imagine, will be covered by UBI. Yes, all of this liquidity will come into the system to combat deflation from AI, but how is it arriving in the general population's hands to pay for what will be an even more expensive house? I think there will always be demand for people to move to Australia. So will it be cashed up immigrants? Or could there be mortgage forgiveness for people already in the system? Or will the people who had money before all the job losses just snap up all the houses, other than Dashdot clients who is able to pay the new prices? And then are we stuck forever in a separated society of people who got assets while they had the earning power to do so? And then the other group who either never got the opportunity or never did anything with the opportunity they had. How do you see this playing out? So there's a lot. There's a lot in there, but you could tell it's obviously very top of mind for this person. And we're just trying to get all of the thoughts out of this is generally what's on my mind. And I'm not quite sure about how they all fit together. What are your thoughts, Goose?
Yeah. So first thing I would say is if you haven't already, go and check out the Prosperity Wave thesis. You can get that for free in the Investor Lab community. And
Mhm.
it kind of like lays out at least my view on a bit of a roadmap of where things are going, which is highly aligned with this question. And it's super interesting, right? Because basically there's some assumptions in there that basically AI is going to take most of the jobs, and that is going to cause a financial strain on the real estate market. Like, how is it all going to work? Like, who's going to pay
Yep.
rent? How's all of this kind of stuff?
Yep.
And so one part of the question in there is, yes. So, yes, all this liquidity will come into the system to combat deflation by AI, but how is it arriving in the general population's hands? Which is a really interesting question, right? So let's
Mm.
sort of take a little step back for those of you who might still be trying to kind of grok what this question really means. So on face value, we need to understand that we are in a monetary inflationary economy, right? Where governments are incentivized to continue to print more money because they need to
Mhm.
combat deflation. Now, deflation is a force that is extremely prevalent through the proliferation of technology and productivity. So as things become, even if we just go back to once upon a time before tractors, farms were full of laborers, right, doing all of the farm labor, and it was very labor intensive. Then tractors came along and replaced all of that human labor and made it more efficient. Now,
Mhm.
that level of technological change has played out across every industry and every part of our society, and it is speeding up. It's compounding, it's accelerating, it's getting faster. Now, what that progression of technology does is that in principle makes everything cheaper. Now, the question you would necessarily be asking yourself at this point is like, well, why isn't everything cheaper, and why do we have consumer price inflation? Why do we have CPI? Well, CPI is the effect of money printing. And so in Australia, on average, over the last 50, 60 years, Australia has increased its money supply by about 10% a year on average, roughly. Now,
Yep.
if we just assume, for the point of this discussion, that consumer price inflation is an average of 2% per year on average, what is the difference between the 2% and the 10%? That difference is the productivity gains or the deflationary gains that have been taken away through monetary inflation. The simple way to kind of flip this around on its head is that if the total amount of currency stayed the same in the system, and the deflationary forces of technology were to take place, we would have roughly 8% compounding price decline across goods and services across the board broadly. Now, because we don't have that price decline, because it's actually kind of dragged up by 10% increase in money supply, that gives us sort of net 2% CPI, roughly, if that makes
Mhm.
sense. Now, understanding that's very, very important, because if you are in an environment where things in the future cost more than they do today, that is an inflationary environment, and that is by design the way our economic system is developed. If you are in a situation where things in the future cost less than they do today, that is a deflationary environment. Now, why is that important to understand? So, in a deflationary environment, people are less likely to spend money, because if you knew that tomorrow, next week, next month, next year, the thing that you wanted right now was going to be cheaper, you would be more likely to wait to buy it, which means less money would circulate, more money would be hold up. People would spend less money. Basically, there'd be
Mhm.
less money circulating in the economy. That has second order effects for businesses. That has second order effects for taxes. That has second order effects for all of these kind of things. And so, what that actually does, as a little bit of a side quest here, that actually decreases consumerism and increases the desire for higher quality goods and services. So, for example, if you were going to buy a table, if you knew that in the future tables were going to be cheaper than they are today, you'd be like, I'll buy a table, and if it's shit, I'll just buy another one in a few years' time, whatever, right?
Mhm.
If you knew that tables would become more expensive in the future, sorry, have I got that right? If tables, have I got that around the right way? Yeah, and basically, if the cost of goods was going to go up over time, then you would be sorry. If it was going to get cheaper over time, I've twisted my head around here. Basically, there's a propensity to higher quality goods, because you're not going to want to replace the table if in a deflationary environment. And
Mhm.
so now, what is important to understand about that is that in relative terms, in a deflationary environment, debt is more expensive to pay back. In an inflationary environment, debt is less expensive to pay back. It's worth
Mhm.
less in the future than it is today. And because in Australia, the total debt to GDP is about 250%, and globally it's about 350%. That's a composite of both government and public debt. Then governments can't afford debt to become more expensive into the future. Otherwise, the entire economy would collapse. Not to mention, in a deflationary environment, there'd be less spending, right? So as AI and technology and productivity increases the speed at which it is, or increases the veracity with which it is applying a deflationary force on the economy, governments need to print more money to offset that, because they can't afford the country to go into a deflationary environment. And so to combat deflation, so the direct relationship between productivity gains is going to be offset by money printing. Now, what happens when there's money printing? Money printing benefits those closest to the money printer first, and that is called the Cantillon effect. So those closest to the money printer are government, and then hard asset holders, then businesses, and then at the end state consumers, in that kind of sequence. So what tends to happen when money gets printed, it doesn't mean that all prices rise equally. So if you take the quantity theory of money, which is that the value of any currency is roughly equal to the value of all goods, services, and assets in a country divided by the volume of currency, gives you the effective value of the money. If you take that on face value, and then you said you double the money supply, then everything should go up in value by double, right? But that's not exactly true. Some things go up more than others. Now, again, a toothbrush is not going to increase at the same rate because of supply, but also hard assets tend to aggregate the value. So in an environment where we can see that there's going to be more money printing because technology is going to drive more deflation, and governments can't afford to have deflation, so they need to print more money. What is going to happen is hard assets are going to go up in value. But we have a paradox, because at the same time, the significant probability is that there'll be significant job loss. Now, there's a lot of people that say things like every technology revolution that we've ever had has destroyed some jobs but created net more jobs on the other side of it. And look, that may be true. But my best assessment is that's probably not necessarily going to be true this time around, because the technology that we are developing right now with AI actually replaces labor. So it doesn't just change an industry, it actually replaces labor, right? And replaces intelligence, and replaces all of these things. So I think it's more likely that we'll see significant job displacement rather than net job creation on the other side. So if you're in an environment where governments need to continue to print more money to stop deflation, and asset prices go up, and there's less jobs, and people can't earn as much money, how does that impact the property market? Well, the thing is, we've seen this kind of thing play out before. And if you joined us for the Great Melt Up episode, or if you've read that report, we discussed how that played out in places like Weimar, Germany. Now, what happened in places like Weimar, Germany is kind of actually what's happening in Australia. So people that owned houses, the value of the houses went up, the value of the debt in real terms went down. So even if the nominal value of the debt stayed the same, in relative terms, the value of that debt went down, right? Even if the dollar value stayed the same. So $600,000 worth of debt became worth less, even though it's the same dollar value. And so the people that owned the assets got wealthy. The people that didn't have the assets couldn't afford to buy the assets, because the asset prices were going up faster than wages, because there was less demand for wages, less demand for employment. So unemployment was going up. There was less demand, and we can see that playing out right now. In fact, I don't know, Gabby, if you let me just quickly get an image here, which I think will be relevant to share at this this moment, because I think it's super relevant to this. Let me just quickly share my screen, if I can work out how to do this. Sorry, don't know why I can't share this. Okay. Sorry. Here we go. So just sharing this image now. Now, the image that I'm sharing, can you make sure this comes up on the screen? The image that I'm sharing here, it's US data, but it shows S&P and total job openings over time since the early 2000s. And you can see that they broadly tracked each other. Now, since the release of ChatGPT in 2022, you can see there's a massive bifurcation between job openings going down and the S&P 500 going up. So what that is a sign of is that businesses are generating the same amount of revenue or more revenue with less people. And there's less job openings, right? So what we can see here is you can have a situation where, and that same thing plays out in Australia as well. Can you stop me sharing that, please? So we go back to
Sure.
so the same thing will likely play out in Australia as well, where you'll have less employment, less income, asset prices go up. Now, what would necessarily need to happen is that governments would need to prop up the people in the society through welfare, and
Mhm.
that's a lot of people talk about UBI. So it's likely that there'll be enough money given to people for them to be able to pay the rent on the places for them to live, but not enough money for them to buy them. And
Mhm.
so part of the question here is, are we stuck forever in a separated society of people who got assets while they had earning power to do so, and then the other group who never got the opportunity or never did anything with the opportunity they had? And the answer is yes. We are already in that. This is not something that is going to happen in the future. This is something that is happening now. We are in the midst of it. These things don't happen overnight. It's not like a light switch where suddenly all of the people have the assets, they get on one side of the room, and all the people who have no assets get on the other side of the room. It's happening now. So the people that are buying real assets are actually progressing and building wealth, and the people who are not buying real assets are getting left behind. Now, and this is a very important thing to understand, is that it is going to continue to proliferate in that direction. Now, one of the parts of the question here is who's going to pay the mortgages? Now, one of the
Mhm.
important things to remember is that debt will devalue with money printing.
Mhm.
Now, to the extent that credit laws or credit policies stay the same, there may still be debt to income ratios, and that may still create some ceiling on asset prices broadly. And we'll talk a little bit more about that in one of the questions a little bit later. But one of the things to remember is we won't need debt forgiveness. So one of the parts of the question was, could there be mortgage forgiveness for people already in the system? There wouldn't need to be, because the value of the mortgage is going to go down. Imagine if you bought a property in let's just say the year 2000 for $100,000, and you had $90,000 worth of debt on that property. You bought it on a 90% LVR, and now that $100,000 property in the year 2000, let's say it's worth $600,000 today, and you've never paid off a cent of that debt. You've got $90,000 worth of debt on a $600,000 property. Rents would have gone up over that period of time. The value's gone up over that period of time. You haven't paid the debt. It's like
Yeah.
such an incredibly low debt, loan to value ratio. So, and this is exactly what played out in Weimar, Germany. That's exactly how Hugo Stinnes benefited so much from the, it's how he became the inflation king. He bought assets, leveraged them up. The government printed more money. In real terms, that debt was worth less. That's exactly how these things played out. And I think that is exactly what is going to continue to play out over the next few years, over the next 3, 5, 10 years. Now, we just to kind of expand on that, I know I'm kind of waffling on a little bit here as well, but there's the then what? What then? Okay, what happens after that? Because that continues to play out until the currency completely fails, because that can't happen forever. So it must necessarily get to a point where the currency fails. And that is what happens, and we talked about that in the Great Melt-Up. That's what happens when trust in currencies dies. All fiat currencies fail. 100% of fiat currencies fail. And so when you get into an environment where the government is printing too much money just to try and keep the system alive, and it becomes, they're just printing money out of thin air. People lose faith in the currency. They don't want to hold the currency, which creates more inflation, which means that eventually the currency collapses. And by the way, that's okay, because that's normal, right? So before everyone starts freaking out, going, "Oh my God, doomsday!" No, that is normal. Currencies die. That's happened. It's happened hundreds, maybe thousands of times, maybe more, maybe even over our entire history. Currencies die. That's okay.
Mhm.
It's just a transition to a new system or a new currency or a new model, and that's okay. It's just part of life, right? It's like everything. It's just a cycle, right? And so if we can understand that this is just a cycle, and that things will change, and that the Australian dollar won't last forever, the US dollar won't last forever, like none of these fiat currencies, unless something significantly changes and they stop being pure fiat, right? Unless they become backed by a hard commodity or hard asset, they will fail, because that is the way the system is designed. So the necessary question then would be, okay, so over the next, say, 3, 5, 10 years, the government prints more money. asset owners become wealthier, people who don't own assets become, or consumers become poorer, debt devalues relative in relative terms to the amount of money being printed. That necessarily on real estate yields would go down because wages and income wouldn't keep up with the rate of property price increase. Unless there's changes in credit policies, then there'll still probably be a debt to income cap, but there's enough properties to continue to rise, and we'll kind of find a put on that. Then what happens when eventually the system just implodes? When eventually just all the money printing collapses, like people don't trust the money, all that kind of stuff. Well, again, there's lots of examples of this. There are tons. In fact, over the weekend, whilst we were whilst we were flying back from Australia, I was watching some videos on this exact topic. What happens when currencies fail? And it went through, I was watching a really great video, went through like 6 or 7 different scenarios of societies where currencies failed. And the same theme emerged every single time. Hard assets, people who owned hard assets got through to the other side and were wealthy, and they were able to carry through. So, for example, the people that owned land, they were able to maintain productivity on the land. People that owned gold, now gold, again, I've expressed my opinions on gold. I think gold is good. Gold's having the best year of growth in probably its like history ever right now, and that is because China's buying up so much gold, but also because people recognize that fiat currencies are starting to fail. But also, but also, capital controls can stop you moving gold around. Like Russia recently put in 100-gram limit of gold leaving the country. Like it's got verifiability issues and all of that kind of stuff. But the examples all pointed to the fact that if you were able to maintain hard assets, you were able to navigate through to the other side of this situation when a new system would be developed. So when we talked about the Great Melt-Up, we talked about the denarius. We talked about the fact that the silver content of the denarius declined from 100% down to 5% over the course of a couple hundred years, and people lost faith in that. And then the government created the solidus, which was like a solid gold coin, and that became the dominant currency in the Roman Empire for centuries. And you would think that they would have learned their lesson, but again, the solidus devalued itself over time as well. They started clipping the coins, and they started stripping out the gold, and again, that led to the ultimate collapse of because the devaluation of the denarius led to the weakening and eventual collapse of the Western Roman Empire, and then the weakening of the solidus ended up crushing the entire economy. So these things happen over time, but the Romans who held the land, the Romans who held actual gold, the Romans who had productive skills were the ones that were able to continue to thrive, and the same things happen everywhere else. So that kind of speaks to how all of this plays out in my point of view. Do you think that's kind of captured everything?
Yeah, it's interesting because the chart that you showed earlier on job openings versus when ChatGPT was launched and like AI became a public tool. You actually posted it in the community with the headline of this is why investment is no longer optional. It's a lifeboat, because if you think through that process of the people that go through this currency collapse, they come out still on top. Literally imagine it like a lifeboat. If touch wood, plane crash or cruise crash or something, if you're on a lifeboat and you hang in there, eventually you'll find land and eventually you'll be okay. And so I think in this, it's, as we keep talking about, as many people as we can get into assets, hard assets, in the next couple of years, the better.
Yeah.
I just wanted to go back to the original question, because I'm just thinking through sitting in that person's seat, because a lot of people in the community are property investors, and again we talk through buying hard assets like property, and a lot of that is leverage, and we build up debt, and thinking through, okay, if AI comes along and I suddenly can't earn an income anymore, how do I pay these 5 mortgages from these 5 investment properties? And you're welcome to debate me on this as well, obviously, but I would imagine that there would likely be some kind of government intervention because I can't imagine they would let the banking system collapse, right? Because there's 2.3, 2.4 trillion dollars of debt sitting in mortgages.
Take a little step back. Why do you think that it would collapse?
Because so much of debt is holding up the economic system in Australia.
Yeah. but debt devalues as money printing increases.
Yeah.
Right. So let's just what is the, let me just quickly Google Australian GDP, right? So it's a really good question, and I think it's great, by the way. So the Australian GDP is 1.752 trillion US dollars. Why is it giving this to me in
Don't want USD. 1.7.
It's about two. It's about 1.8 trillion. It's about 1.8 trillion AUD, I think. Okay. I'm getting
1.8.
some weird numbers here.
Yep.
Yeah, it's about 1.8 trillion, right? So let's just take it on face value that it's 250% debt to GDP ratio, which is not exactly right. So 1.8 times 2.5 is 4.5. Right. So let's say there's 4.5 trillion. I don't think I've done the maths exactly right. Right. Let's say there's 4.5 trillion. If the government prints twice as much money and the debt stays the same, what happens to the debt?
Yeah, the LVR goes down over time.
Yeah.
But okay.
But it literally devalues the debt, right? Literally devalues the debt. So the way to kind of like put this in real terms, right? Let's say it costs you $1,000 to buy groceries, and let's say you owe a debt of $1,000, right? So your debt is equal to $1,000 worth of groceries. If in 5 years' time that same amount of groceries costs $2,000 because of inflation, because of monetary inflation, and your debt is still $1,000, then your debt is worth half that same amount of groceries.
Yep.
Right? So in real terms, your debt is worth less.
Yep.
Right. And so it devalues the debt. So the debt is not going to collapse. They're just going to, it's called a soft default, basically. A hard default is when they just say, we're not going to pay the debts. And a soft default is when they print the debts away. Right. So,
So Catherine's put through a follow-up question in here because it's kind of my line of thinking as well. Like the devaluation will take time though. So what happens beforehand?
I don't understand.
Like in the immediate term, follow up in the immediate term when an investor has just lost their job.
Yeah. Okay. So let me rephrase that. So if job destruction is faster than monetary inflation and debt devaluation, basically what happens if everyone loses their jobs, right? Before so I think that is where government intervention will come in, right? But that'll come in the form of welfare. Not coming in through, so it'll come in through the form of UBI and propping people up and make sure there's enough. So the first thing they will do, so the government, the federal banks are basically broadly mandated for stable prices and maximum employment. So if unemployment goes up, what are they going to do? They're going to try and stimulate the economy to try and stimulate more jobs. What is that? That is money printing. Now, governments also, because it's politically unpopular to have high unemployment rates, they will continue to create more government jobs to soak up that unemployment, which is by the way, exactly what has been happening in Australia over the last few years. Right, private sector jobs have been declining. Public sector jobs have been increasing, and government deficits have broadly been increasing, specifically to be able to employ more people to keep unemployment rates down. So this is already happening. So people think that this is something that's going to happen in the future, but let me just tell you, this is something that's happening right now. And so you are currently inside the scenario that you're imagining might happen. It's currently actually happening. So the government is creating more jobs. It's running inefficiently. It's running at massive deficits. It can run at deficits because it can run up debt, and it can print more money to cover those deficits. Right. And so the way that works is the government stimulates the economy, it lowers interest rates, it prints more money, it stimulates the economy to try and create more jobs artificially. Then once that no longer works, then they'll be forced to take other measures, which will be things like UBI. So in the meantime, asset prices continue to go up. And I think, I think that there's we have to remember there's a massive housing shortfall, right? So, currently rental vacancy rates are at record lows nationally. And so let's say someone loses their job and can't afford to pay rent and they have to move out. Somebody's there to take their place. Now, what we're talking about there is potentially homelessness, right, for a lot of people. But there are so many people that want to rent that the underpinning of demand for rent is still continues to be there. For that level of demand destruction to take place, where say national vacancy rates rose to like, let's call it 5% or something like that, where you would actually start to have trouble controlling rental prices and all that kind of stuff, would be very, very, very significant. We're nowhere near that, right? And so, as these things continue to play out, the most likely scenario is if the jobs market became crippled and wages became crippled, the most likely scenario is that rents wouldn't be able to rise as fast as they currently are rising. And so what that would mean is that yields are going to go down, right? Or, if rent stayed the same, if rent stayed exactly the same, but property prices went up, then yields go down in relative terms. Now, why does that matter to a property investor? Well, if your yields are going down in relative terms, that means less opportunity for positive cash flow, and also debt to income ratios are going to be affected because you're going to need to get more debt relative to the income that you can attribute to the property as well. So that is going to make it harder to get more debt. So that's the piece that's going to then potentially put a cap in some markets on price expansion. So like Sydney market, for example, is already significantly overpriced relative to debt to income ratios. So the likelihood that market is going to be significantly impeded in price growth in the future is very high. Does that make sense?
It does. Yeah. Related to the yields piece, Catherine's just had another follow-up on about if investors should potentially hold on to more cash over the coming years to kind of handle that negative cash flow.
So I'm not going to give financial advice on that. I will give you my opinion, because I think everyone needs to manage risk in their own way. I personally would not want to hold on to a pile of cash whilst I knew that it was being devalued, just in case I needed some cash in the future. What I would want to do is I would want to allocate as much of my cash as possible into as many different places as possible. And I would treat hard assets like a money market account. So, for example, rather than keeping cash in the bank, I might deploy that cash across 3 to 5 different liquid assets and probably grow my capital and understand that I could liquidate them in the future if I needed to use that capital somewhere else. So, and that's how, obviously you and I both actively involved in our money, but I do most of our liquid capital allocation. And that's exactly how I think about it. I keep the minimum amount of cash that we need to be able to cover our expenses or any kind of like near-term costs. And then I allocate the rest of the capital into liquid assets, because we can sell those liquid assets later if we need to, but at least we've got the opportunity for appreciation. And so, if I was a property investor, would I want to have 100% of my capital tied up in property? No, I wouldn't, because it's not very liquid. So if you found yourself in a situation where you were, where there was a situation where you needed a lot of capital, let's say, I don't know, something major happened to a property, tenants moved out. Like, let's say you were in a position where you suddenly needed capital, but then you needed to liquidate the property in order to liquidate some of your real estate assets to get the capital. That's going to be much harder than liquidating more liquid assets. And so, I think a healthy allocation across some liquid and some non-liquid assets, because you can still have liquid hard assets, is kind of the way to navigate that. So yes, you want to have capital reserves, but I wouldn't hold that in cash. I think go on.
No, it's because I think if you think through, we've done a few episodes comparing different asset classes, but if you think about that characteristic of liquidity, if you think about that as an axis, being liquidity in this sense being like ability to convert into cash, property is on the very bottom of that axis, right? But most other asset classes are more liquid for you. So there are other things that you can have in between property and cash that would be more accessible if you need it to convert it to cash to cover things like negative cash flow.
And there's a ton of ways to do it, right? You could buy bonds. Now, bonds lose value over time, but they're better than holding just cash, right? You could buy bonds. Let me be very clear. I'm not recommending anyone buy bonds. I think they're shit, right? But but you could, if you wanted some asset that has an extremely low volatility, right? If you wanted something that's got low vol but doesn't have but at least accretes some value, then you could. Well, I mean, they're still bonds are still net negative value, right? They lose value over time, but they pay a dividend or whatever. But then you can go all the way out on the spectrum and say you could treat Bitcoin like a money market account. So money market accounts are effectively places that you would park your money if you needed short-term access to capital. Now, with the way that organizations and governments do that is they keep them in things like T-bills, which are like overnight treasuries, basically, right? Short-term treasuries, right? Which they can turn over quickly in a moment's notice. I personally like to think about different assets. Like I like to think about what's my money market account right now. So we hold a not insignificant amount of MicroStrategy or strategy, as it's called now. And the reason we hold that is because I was like, that's Bitcoin that we can sell, right? That's like, it's effectively money market.
Without having to sell the Bitcoin.
Yeah. It was like, all right, cool. So like, I want some Bitcoin that we can sell, right? That has high volatility and all of that kind of stuff, right? And so the premise of that was that, okay, so let's say something came up that we could sell that, to a lesser extent, but also to a similar extent. I think of Tesla as a money market account. So, okay, I mean, like, why would I hold cash when I could buy an asset that I think is going to do well over a medium term? As long as we've got our near-term cash considerations covered, I'd want to keep it in something liquid. Now, different people, different volatility risk and all that kind of stuff. But I like to think about what assets can I treat like a money market account without just having pure exposure to debasement.
Yep. Cool. We need to get cracking.
We do need to get cracking. We're not going to. I don't think we're going to cover off everything. I think it's actually good to go a little bit deeper on this. I think
for sure.
Let us know in the chat if you think it's better for us to really dig in and start to like pick these kind of things apart and kind of get into the nuance, or whether you prefer us to kind of move a little bit faster. Because I'm quite happy. I think it's a really good question to ask because we're trying to we're all trying to unpack like what the hell happens, right? And so what I'll do is I'll just quickly recap on some of this because I think it's important. Cool. So what I believe, and I am just a guy, right? And I don't know the future, but I'll just say what I think, what I reckon, right? What I reckon is going to happen is that AI and technology is going to cause significant amount of deflationary force and also job loss. To combat that, the government is going to need to print more money, whether it be to fund welfare, whether it be to stimulate the economy, whether it be to do any other number of things. That will cause hard asset prices to increase. So specifically, real estate is one, but also other hard assets, right? So anyone who listens to this show knows that the kind of exposure ratios that we look at is a combination of real estate, Bitcoin, and disruptive equities, so growth equities, right? Growth technology. So it's going to cause hard assets to go up in value. Those who own hard assets are going to increase their wealth. Those who don't are going to get further and further behind. It will continue to create a wider and wider divide between asset owners and consumers. The government will need to continue to print money to pour into that big black hole chasm that forms between those two. That exacerbates the issue and makes it worse and worse and worse and worse and worse. Yields are going to go down on real estate because wages are going to stagnate or potentially decline in real terms, which is going to mean that rents can't go up as fast as they have in the past, and so so rents are likely to rise slower than asset prices. There is a huge underpinning of demand behind rents already and will continue to be as more people are priced out of the property market, which creates a structural floor on rents, which means that we're not suddenly going to see a rental collapse overnight, I don't think, because there's too many people that need to rent. And as more people are priced out of the property market, more people are going to continue to need to rent, which creates a perpetual floor. That creates other issues in society, which will perpetuate more money printing, which means property prices go up, which means more people are priced out, which means more people need to rent, et cetera, et cetera, et cetera. Now, that'll continue to happen until it doesn't happen anymore, in which case there'll be an economic regime change, and those holding the hard assets will be the ones who transfer to the other side of that regime change effectively. So the game here is how do you hold as many, how do you own as many hard assets as possible so that you can transfer that wealth into the future, and keeping a decent portion of that liquid so that if you find yourself short on an illiquid asset, you've got some capital to cover that. Perfect.
Okay.
Awesome.
I'm going to jump to question 2 because I think it's question 3 because I think it's related.
Okay.
Let me just pull it up.
Oh yeah, sick. This is a great question. This is RuPaul's question. Right. Yeah.
Sick.
Hey RuPaul. Hey Alish.
So I'll read it out again. We have been heavy real estate investors, but after joining this community, we are diversifying into crypto, Tesla, ETFs, etc. We're constantly hearing conflicting views about Bitcoin, Tesla, and other stocks. My
Mm.
husband and I decide on a strategy for flat cash investment and regular monthly contributions one day, and in a week's time, we hear conflicting opinions and we feel like we should change our strategy. I feel you on that. I have realized we do not have the appetite or time to constantly monitor the market and adjust our strategy. What is the more balanced strategy you have been following? I don't want to be blind to what is happening in the market, but also I don't want to monitor every day and every week. I would like to have an investment strategy that I can monitor once every 4 to 6 months. Is this possible? Interested in stocks, Bitcoin, ETFs, and other cryptocurrencies? Great question.
It's a great question, and I really love this question.
Mm.
So, obviously, this is a non-property question. I'm going to be focusing on specifically liquid assets, which is what all that is: crypto, equities, ETFs, all that kind of stuff. Now,
Yep.
the first thing I would say is that you need to understand your investment type, your investor type, your
Hmm.
investor profile.
Yep.
Some people prefer to be active investors. Some people prefer to be passive investors. Some people enjoy watching stock price movements on a day-to-day basis. Other people get stressed out by it.
Mm.
Um, so some people love like day trading. That's not me. For personally, it's not. It's too. I don't. It's too. It stimulates too much cortisol. So I
Yeah.
prefer to. I'm very much more macro, right? So I like to think about how do you identify the right themes and the right ideas over a longer period of time, which means that you can zoom out and over a higher time frame, you can have less stress, right? Which
Hmm.
also means that. So it's just to answer a part of that question: is it possible to have a strategy that you can monitor once every 4 to 6 months? Yes, it is possible, with some caveats. So the first thing is like you have to kind of really think about like what type of investor are you? Like, do you want that kind of stimulation all the time, or do you want stuff that you can buy and just have confidence in that you're doing the right thing? Now,
Yeah.
there's a sequence that you need to kind of follow, that everyone needs to follow before they start investing. Now, I was talking to some friends about this recently whilst I was in Australia, and it was super interesting because everyone wants the hack, right? Everyone wants to like, how do I get to the result? How do I get to like the fastest returns or the best or whatever? But actually, you need to develop you need to firstly develop the skill of identifying what assets you want to be in. So the sequence that you need to follow is fundamental analysis first. And that is actually thinking
Hmm.
about what do you want to invest in and why do you want to invest in it? Like what is it? Is it Bitcoin? Well, why do you want to invest in Bitcoin? What is your fundamental thesis on that? Is it Tesla? Is it the S&P 500? Is it copper? What is the fundamental reason that you believe that you should be investing in that? Then the second part of the sequence is technical analysis, which is when you should invest, and the third part of the sequence is the investment method. How do you invest? So first is fundamental analysis, second is technical analysis, and third is investment method. Now, the place to start is by picking 3 to 5 companies, indexes, or assets that you want to invest in, and then you need to spend the time to do the research and form a thesis before you invest. Like before you even allocate a single dollar of capital, you need to have developed a thesis on why you're doing it, why you think that this is the right thing to do. Because having personally gone through this journey myself of like, oh, I heard that this is good, I'm just going to put a small amount of capital in there. You do that and then the price changes and then you feel terrible about it and you don't really have a fundamental reason for being in it. And you just don't, it's not good. Like you haven't
Hmm.
formed an opinion. So you have to form a thesis and then you have to pressure test your own thesis. So, okay, so I think I'm just going to pick Tesla, right? For example, right? I like Tesla and I'm going to buy Tesla, right? Well, why? Why are you going to buy Tesla? What's your thesis? Is it because you think they're a really good electric vehicle manufacturer and you think they're gonna dominate the EV market? Well, that's probably a good basis on which you should pressure test that thesis. Where could that go wrong? Where might your personal biases be leading you astray? Because I can tell you that, like Tesla does well in EVs, but there's lots of Chinese companies that are competing and all of that kind of stuff. They're not an EV company. But if your thesis is that, then you need to pressure test that. So, like, why? Like, develop your thesis. Then you actually need to go and pressure test it. What could go wrong, and where might your biases be leading you astray? Then you also need to work out your investing timeline,
Hmm.
right? And that's very important. So, for example, when I think about Bitcoin, the investment timeline for Bitcoin is 4 to 5 years. So it's like, I don't recommend you buy Bitcoin unless you're prepared to hold it for 4 or 5 years. If you're buying it to try and sell it, to try and trade it, to try and do all this kind of stuff, and this is just me personally, and lots of people have probably made shit tons of money trading and doing all that kind of stuff. But for me, my investment timeline for Bitcoin is 4 to 5 years. So I'm not thinking about selling it. I'm not like, oh, I wonder when the peak of the market is going to be, and I wonder when it's going to. No, I'm not really. I don't really care because, if we bought in 2024, then I don't really care about anything unless it's 2028, 2029. You know what I mean? So I'm kind of looking at and what's the probability that it's going to be higher by then? Pretty good. So if it goes down by 20%, I don't really care because, psychologically I've locked that away until sort of 2028, 2029 before I even think about selling any of it, if we sell any of it.
Yeah.
So it's what's your investing timeline, and your investing timeline can be different, and it should be different based on your thesis. Because if you think that something is, look, if you're in a make money trade and you think that something's tied to the liquidity cycle, for example, you may say, I'm going to hold this until, like, what's my thesis? Right, I think that this asset is highly correlated with liquidity, and I think liquidity is going to peak in Q2 2026. Therefore, my timeline for this asset is I'm going to hold until, I don't know, Q4 2025, and then I'm going to sell down 30% of it. You have to have your timelines in mind before you get started. And that also goes to understanding both your entry strategy and your exit strategy and your position sizing, right? And you need to think about all of this kind of stuff before you get into it. And I'll use Tesla as an example. You might decide, you might do a bunch of research. You might go, oh my God, Tesla is awesome. I love it. Let's go buy some Tesla. Well, I mean, if you look at the stock chart at the moment, it's just rallied by, I don't know, like 50% in the last couple of weeks. So is now the right time to buy? You may have correctly identified the asset. You may go, this is perfect. I'm so into this. I really want to buy Tesla. Does that mean that you just go and, pour a whole bunch of capital into it straight away? No, you need to actually do some technical analysis and ask yourself, when is the right time to invest? Should you wait for a pullback? Has it significantly overextended itself versus the market? I'm just wondering if I can potentially share something here. So I'm just going to quickly look at this. Give me one hot second. I'm just going to share. I'm going to share my screen. And I will show you exactly what I mean about this.
Cool.
Share screen. Okay, so now one way that I like to think about timing is I like to think about using a relative strength indicator. So, for example, if something is overbought, then it's not the right time to enter. And you can see that Tesla, for example, has had this big spike just here. So you might be like super into Tesla. You may be super into Tesla, but it's just gone from here to here. It went up, 32% in the space of whatever, I don't know, a week, couple of weeks or something like that. So you can see here, if you use a relative strength indicator, that it's actually a little bit overbought at the moment. And so you may say, okay, I'm super into Tesla, but I want to wait for a bit of a pullback to when it's a little less overbought and it's a better entry point for that asset, right? So thinking about the timing and the entry and exit strategies is really, really important. When am I going to buy it? At what levels would I buy it? When does it make sense? And also, when am I going to exit? At what point would I exit? Now, I'll use some examples from our own personal stuff. And there's a fair bit more to unpack on this topic, right? But I'm just trying to walk through a few things carefully. I think it's good to trim positions. So, for example, we bought Rocket Lab at $12 and Palantir at $25. Now they've gone up a lot, right? So Palantir is currently trading at $187, right? So significant upside on that, just by buying spot equity without doing anything fancy or anything like that. But we took our capital out of that trade ages ago, so we've sold half of the position. We sold 50% of all of the equity that we bought in Palantir. So now it's like, okay, well, the rest of it can just like kind of ride forever. Like, it doesn't really matter because we're playing with the table's money, which is really, 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 really important to understand. So really think your nose through. So pick 3 to 5 companies, indexes, or assets that you want to invest in. And so there's a good question in there, which we'll get to. But you want to pick
Yep.
3 to 5 companies, indexes, or assets that you want to invest in, and spend the time to do the research, form a thesis, and pressure test that thesis. By the way, this doesn't have to be complicated. So I'll give you a really good example. Rocket Lab. All I needed to know about Rocket Lab in order to invest in Rocket Lab was that at the time it was 1/8 or 1/12 of the size of SpaceX, but it was the only other company that was actually commercially doing low Earth orbit satellites successfully. And I was like, what? That's crazy. What a huge, I didn't go study the balance sheet. I was like, I mean, that seems like a no brainer. Like, look, I did do a bit more research than that, but I spent a couple of hours on it, not days, not weeks. And I was like, okay, this makes a ton of sense. And I'm going to allocate accordingly. And we allocated what was, and this is the position sizing piece. We didn't allocate 50% of our portfolio. We allocated 3 or 5% of our portfolio to that asset, but then it went up significantly, right? So now it makes up a more significant portion. So understanding that's really, really important. Now, back to the question, right? So once you've established what you want to invest in and why you want to invest in it, and really just sort of thinking through, okay, when am I going to invest? What's my long-term thesis? How long do I want to hold this asset? Then the question is, should you do things like dollar cost averaging, or like how do you not stress out about it, basically? Now, mathematically speaking, you are statistically more likely to get higher returns over a 10 to 15 year period by lump sum investing, by taking all of your available capital and just dumping it into an asset on day one, regardless of whether it is at a high point or a low point or anything like that. Obviously, if it's a low point, it's even better. Now, the reason for that is because as you dollar cost average over time, and for those of you who aren't aware, dollar cost averaging is the idea of having a specific set amount every day, week, month, or whatever that you're going to invest in an asset consistently over time, just on a kind of a programmatic fashion. Now, the problem with that is that as the asset goes up, you're constantly buying at a slightly higher price, which decreases your overall return, but it also smooths out your risk because you don't have as much risk involved in it. And so if you're not super comfortable to just like dump a bunch of capital in something, then dollar cost averaging is a better way to manage that and make it a little bit easier, a little bit simpler to kind of smooth things out. It means you don't have to put as much you don't have to have so much risk or fear around the timing. Like, oh my God, what if it's expensive? What if it goes down? What if this? What if that? Like all of this kind of stuff. And you can do a combination too. You can say have a high conviction in Tesla, but still be feeling a bit nervous about it. And then maybe you invest, I don't know, a small lump sum at the start, and then you dollar cost average over time as well. Now, one way to think about dollar cost averaging, which I think is a really good, and I borrowed this from Tom Nash. So Tom Nash, any of the people that I follow on YouTube or anything like that, I never agree with everything they say and everything they do. So for example, like Tom Nash, he doesn't like Bitcoin. He's anti-Bitcoin. Okay, that's fine. But I think he's got some really good investment. Like he's got really good investment methodologies and analysis, and it's quite good, right? And same thing goes with like, you know, Raoul Pal or Invest Answers and stuff. Like I don't agree with 100% of anything that any of those guys say, but individually they have great little bits. One of the things that Tom Nash talks about is, or his dollar cost averaging strategy is basically to pick an amount that you want to invest every week or every month or whatever it is. But then when a stock drops more than 20% below its 52-week high, that's when you double down, as long as your thesis hasn't changed, right? Which sort of gets me onto, which we'll get onto another point in a second, right? So before you start investing, you have to have a thesis. Why do I believe in this company? Why do I think that this is good? Then if the price goes down, you only need to be concerned if the thesis has changed, right? So if something has fundamentally changed about the asset that you've invested in, and the thesis has changed, and the price has gone down, well, that's where you might want to start to question, okay, do I also want to be in this? But if the business hasn't changed, or the asset hasn't changed, and the thesis remains the same, and the price goes down, then you're getting the same asset at a cheaper price And so you should buy more of it in that dollar cost averaging strategy.
Mhm.
So that's why it's so important to come up with the thesis at the start, because you have to have a conviction. Because if the price drops by 20 or 30 or 40% and you don't have a strong thesis, if you don't understand why you're in that investment, then you're going to be like, oh, this sucks. This thing's just lost a bunch of money. This is crap. I just want to get out of it. And you'll bail, and you'll do what most investors do, and you'll just bail at the wrong time. You buy high, you
Yeah.
sell low, you lose a lot of money. If you have developed a thesis, and then when the price goes down, you can reasonably ask yourself, has my thesis changed? Is there anything that's structurally different about any of this? And if the answer is no, and you still believe in your original thesis, right, then you're buying things cheap. It's like, great, awesome. Like, let me get after this. You know, I like to look at 200-day moving averages personally, because well, they don't work for everything, but for some assets, so for like Bitcoin, MicroStrategy, Tesla, the 200-day moving average is an awesome reference point. When it goes below the 200-day moving average, 100% of the time, that's been a great opportunity to buy, right? Just to continue to accumulate at a faster rate. And so going back to kind of RuPaul's question, basically they're feeling stressed out. They want to diversify, but they're consistently hearing conflicting views about Bitcoin, Tesla, and other stocks.
Yep.
We decided on a strategy for flat cash investment and regular monthly contribution. And then we hear all this other stuff, and we feel like we need to change our strategy. We don't have an appetite to constantly monitor the market and adjust our strategy. What's the more balanced strategy to follow right now? So my advice to that is pick an asset that you're going to be comfortable holding over the appropriate period of time that you don't need to worry about it. So if you're only planning on holding an asset for a month, then yeah, you're going to need to pay attention to the price a lot.
Yeah.
If you're planning on holding an asset for a year or 2 years or 3 years or 5 years or 10 years, then it doesn't really matter so much. So you can develop your thesis and allocate your capital and just check in periodically to make sure that your thesis hasn't changed. And that's it. And then in terms of capital allocation, you've got to do whatever's going to be best for your own cortisol, right? If you don't have the stomach to kind of allocate all of your capital and let it ride, then invest in smaller amounts and do it programmatically over time, even though that may lead to, lower overall outcomes. So.
Yeah, just the piece in there about like conflicting advice as well, and conflicting information and guidance. I think we get different levels of again, on an axis of like tactical to strategic insights about, Tesla, for example. So let's say that you're thinking you want to buy Tesla. All of this, guys, not financial advice, but
yeah.
Let's say
Nothing, yeah. Let me just reiterate. None of the assets we've mentioned on this are recommendations to go buy those assets, by the way.
Because again, timing.
None of them. Go work it out yourself. Go work out what works for you. So keep going.
Yeah, but let's say you have this idea that you want to invest in Tesla, but then, and you've thought about it at a strategic level because you think, the way that the industry is changing and moving towards a more technology-based society, I'm going to place a bet on that at a more macro level. Yep. But then you hear, someone your neighbor down the street, it's like, oh, Elon Musk did something dumb. Tesla's a dumb company to invest in. I'm simplifying. Yeah. But that's at a very like tactical reactionary level versus the more macro zooming out of, no, I believe in where this industry is going, regardless of the tactical daily, weekly, monthly changes. So I think that's one thing to factor in as well. But the other piece is like, unfortunately with this stuff, if you're going to invest in individual stocks, you kind of do need to do the research. Like you need to invest the time and the hours to build that skill set. Again, there are other asset classes to invest in if you don't want to do that. Alternatively, and you and I had a heated conversation about this on the weekend, so we're definitely not recommending this, but people have a tendency, if they don't want to do the research, they go to someone like a financial advisor who will just like put their investment into something safe that will get a consistent, safe return, but they're not trying to maximize your return, right? They're just trying to get it to a little level of the amount that they can justify getting.
That's what they're going to do.
They'll get like an $8,000 fee a year. So they're not incentivized to take risks with your investment, right? So there's not really services that can help you with it either, unfortunately. So that might be better than holding it in cash. But if you are wanting these kind of outsized returns, it does require research and putting in the hours.
Yeah. So yeah, I want to expand on that too, because I think what's really, really important is zooming out. Anytime I
Yeah.
feel stressed, I zoom out.
Yep.
And that's why I love macro. And that's why people hear me talk so often about things like
Yeah.
liquidity and AI
Yep.
and stuff like that.
Yep.
Because on the day to day, like all kinds of shit can happen on the day to day. Who cares, right?
No.
But
Yeah.
on the macro,
Yep.
can I see that liquidity drives asset prices? Yes. On the
Yep.
macro, can I see that governments are going to print more money? Yes. On the macro, can I see that the world is going to be more digital tomorrow than today?
Yep.
On the macro, can I see that AI and robotics are going to proliferate significantly? Yeah, all of these things. Okay, great. So I don't need to be too caught up in a specific earnings report or anything. Like, doesn't really matter, because my time
Yeah.
frame, I've zoomed out, right? And so by zooming out and by focusing on the macro, you're actually able to stay way, way, way more calm if you just zoom out. When you zoom in, you increase the frequency of information, but that just increases the stimulation, which also then means when you zoom out, you're also going to have a high level thesis. So let's just take Bitcoin for example. Let's say you've done a bunch of research and you go, I think Bitcoin's a good idea. I think that fiat currencies are going to fail and that Bitcoin is a great hedge against the debasement of fiat currency. Great, perfect.
Yep.
I'm going to all right. I'm going to go buy some Bitcoin, and then you go catch up with your friend and you say, oh man, I've decided I'm going to buy some Bitcoin. I'm really excited about it. I think it's a great way to hedge against the debasement of currency. And then, and maybe you've already invested. Let's say you went, all right, I'm going to do it, and you bought $100,000 worth of Bitcoin, right? And you're like, yes, right, perfect, I did it. And you went to your friend. I said, oh yeah, I bought $100,000 worth of Bitcoin yesterday, and I'm really excited. I feel like I've really made a really good decision about my future. And then your friend turns around and they say, what about quantum? Isn't quantum computing going to destroy Bitcoin? Isn't it going to crack the? Oh, I think you've made a big mistake, right? Necessarily, it's going to cause you to feel a bit stressed out. But that's where you get to go back to your thesis. That's where you get to go. Oh, okay. What's changed about this? And with that new piece of information, can I validate whether or not that is going to change my thesis? Like, all right, maybe I need to look into it. But if you zoom out and you've got a long enough time horizon and you have a thesis that you have actually written down, I think you should actually write down your thesis. So you can actually literally create a one pager. I don't do this personally, but I have a different methodology for doing this, but effectively I do this, right? What is the thesis? So write it down, literally write it down. What's the thesis? What are your price expectations? What are your targets? How do you know when to enter and exit? How would you know when to rebalance? All of these things. Write it all down. And then when you get a new piece of information, you feel stressed, you can go pick up that bit of paper and look at it again and go, okay, has anything changed? And that's really the key. And I think everyone can get very caught up in the day-to-day noise. And that's why zooming out and having a very macro thesis is very, very important.
Yep.
Right. So, you need to look 3 to 5 years ahead and ask. And me personally, the way that I think about making investments is I think about them with a 3 to 5 year time horizon. I've already mentioned the Bitcoin one, but it really and it's no secret. We own equity in Tesla, and my view on that is I don't really care what happens this year. Like, I'm not interested really. I wish I wish the stock price would stay lower. I wish it'd go worse. In fact, I wish it'd perform worse. I wish it would go down. Like, it's not very often you hear, but I wish that my investment would go down in value, because then I could buy more of it cheaper, because I think in 5 years time, I think it's going to be worth a lot more. My personal thesis, not a stock recommendation. Do your own research, right? So, and a lot of people disagree, and you can totally disagree. You might think that Tesla's the worst company in the world. That's totally fine. You can invest in something else. Totally awesome. Great. There's tons of great investment opportunities out there. There's tons. There are so many good investment opportunities out there that you can't possibly even catch them all. You just got to work out which one's right for you. But if you have the long enough time horizon, then you don't really worry about the day to day. I just look for price dips, so I know when to buy, basically.
Yep. Yeah. Particularly as like Shampoo Time has put a great question in about how do normal people have the time to do this, which again, reiterating, we are business owners. We have a lot going on as well. We
Yep.
don't want the extra stress. So part of our thesis, generally speaking, is to choose longer term assets that are more
Yep.
macro focused versus someone who may have a little more time on their hands. They need to maximize their return in the quickest amount of possible, shortest amount of time possible.
Yep.
So they have more time to research, so they can do more, like maybe not day trading, but more shorter term strategies.
Can I also just add, that's also why you don't want to have too many assets.
Hmm.
Like I said, 3 to 5.
Yeah,
Maybe it's 1 to 3. Like,
yeah,
because you're right, you don't want to be trying to track 20 different assets.
yeah,
Like you want as few as possible, whilst also making sure you have exposure to the right drivers. It's probably the right
yep,
way to think about it.
yep,
And so you don't want 10, 15, 20 assets that you're constantly trying to track, and when should I enter, when should I exit, and this and that and the other, and blah, 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 blah. You want a few. You actually want to
yep,
concentrate your bets. Some diversification is important. You want exposure to different key drivers, but you actually want to try and work out what is the one or two, or you know what are
yeah,
the 1 to 2 max allocations you can make based on a specific thematic driver, and then just stick with that.
yep,
Like what is your AI play? What is your real estate play? What is your like? And
yep,
don't try and have 10 or 20 or whatever different. But if you spend the time to develop conviction on 3 to 5 different assets and investments, you
yep,
develop that conviction, then you only need to think about those. And you can keep your eye out of interest, and keep thinking about other stuff or whatever. But then it's going to have to fight like hell to kind of get a seat at the table against the things that you've already developed conviction on. If
yeah.
anyone's seen, I did an exponential age index, and it started with, I think, and I posted it in the community. I think it started with 30. I think it's down to like 16. We don't own
Hmm.
16 equities. We own 4 or something.
Mm.
Right. And it's not about owning a lot of things. It's about developing conviction on a couple of things. And then you just need to pay attention to those. And then don't even need to pay attention to them very often. There's
Yeah.
there's an investment that we are in, which is a very active investment. It's a kind of like and it's a very small portion of our portfolio, but it's an AI hedge trading thing, and I'm in a group of people that are in with this community, and they're so active. They're constantly pinging each other. Oh, it's gone up and it's done this and it's the whole all day. This WhatsApp group is just, I haven't looked at it in 3
Mute.
I haven't looked at it in 3. Yeah, I have the chat on mute, and I haven't
Oh,
looked
not
at
muted.
the investment in 3 weeks. I'm like, I don't know, it'll work
Yeah,
itself out. Like
yeah,
I
but
have
some
a
people love
belief
it.
that I have a belief that this is going to go like that. So that's cool.
Yeah,
Great.
yeah.
So
It's
RuPaul, I hope that's helped, by the way.
yeah. I was just thinking through the like conviction is what we're aiming for here, because I think through
Yeah.
like people, if someone now came along and tried to tell us like real estate generally was about investment, it's pretty hard to shake that out of us. It's pretty hard for us to go like, oh, maybe they're
Yeah.
right. Similar with Bitcoin and things like it's the more that you develop your conviction, the less swayed you will be from other
Yeah,
opinions.
but you got to be really careful about that too, right? So you still have to always be open to
Still
being
be
wrong.
open to the research and the what's
You have to
changing
be
for
open to being
sure.
wrong.
But
You
yeah, but you
absolutely
can imagine
must be open to being wrong.
if
Yeah, go
someone's
on.
just learned about Bitcoin and they're like, "Oh, I think this is a good thing," and then again, their neighbor says, "It's so volatile. I lost $50,000 last week." If you haven't developed that conviction, you're more easily swayed to, okay,
Yeah.
this is I shouldn't do this.
Yeah. But you should never become wedded to a single idea.
Yep.
Like you should never like that. That's a recipe for disaster. Like that's a recipe for you to go down with the sinking ship. Every
Yep.
company, just like every company fails eventually. Every company either shuts down, dies, dissolves, or gets acquired over time. Could
That's
be
true.
100 years
Yep.
or a couple hundred years. So there is no now commodities are different.
Mhm.
And real estate is more like a commodity.
Mhm.
So real estate doesn't die over time. Real estate continues to appreciate over time, so it's quite safe from that in that regard.
Yep.
But all companies die eventually, so never get wedded to a single idea. But you need to develop conviction, and you always need to be prepared to pressure test your own assumptions if new information comes to the table. So.
Yeah.
But just sort of going back to RuPaul's point, how do you do that in a low stress way, right? I just want to reiterate, how do you do this in a low stress way? Don't try and analyze the entire market. Work out what things you're interested in, right? So are you interested in the fact that the world is becoming more AI and you want to get exposure to that? Are you just like work out what you have an interest in, right? Spend the time to develop a thesis on why or why not, why you think that will or won't work. Then invest in a way that is invest on a timeline and in a method that is aligned with your personal, your personal idiosyncrasies. If you want something that you're not monitoring on a daily basis, buy something where you've got conviction over a 5-year time horizon that's going to work out over that period of time. If you're worried about price swings and you don't cool, allocate some capital up front and then do a dollar cost averaging strategy and then move on. And that's it. And just move on. Right. And that's how you kind of start to take the stress away. Don't try and pick every winner. You're not going to get them all. We've missed, I've identified probably 30 companies that have gone on to produce exceptional returns that we never invested in because I identified them and I realized that in order to invest in them, I'd have to take money away from things we're already invested in. And I wasn't prepared to do that. So I was like, well, I guess we're just not going to invest in them. Simple. Because I don't want to track 20 things. So
yeah. As well, guys, I think if you are relatively new to this, all of the AI tools and LLMs that we have available to us now are so valuable for developing your understanding. Don't let it make investment decisions for you. But in terms of research and figuring out what platforms should I look at to get this information, they're really great to help your learning. So if you've ever felt like there's who do I go to ask these questions, obviously we are here, we have the community that you can ask questions in as well now. But if you want a bit more of a coaching type thing, ChatGPT, Perplexity are really great for developing your own understanding because it's quote unquote unbiased platform that you can just have a conversation with and go, hey, I'm interested in learning how to do dollar cost averaging in the technology space. How would I approach doing that? It's just these tools that are available to us now have never been available to humans before. So they're really valuable for just developing your understanding as well, because you can just ask those questions. Goose, we have 18 minutes remaining.
Yes, let's skip the Sydney affordability one and let's talk about the cycles getting shorter because I think it's relevant to it's actually relevant to the last two questions that we've had, right? Because in the last two questions we've talked about property market and we've talked about volatility and all of this kind of stuff, right? And so
so question 2. Is this the right question? Yes. Okay. I would be interested in an episode about the cycles in Australia are speeding up. You've mentioned that you are now investing in places you invested in when starting Dashdot. How do you see this playing out in future? What's going on here? Are real human beings moving around more, or is it investors?
Yeah, so it's a really important thing to understand that the Australian real estate landscape is changing, right? So there used to be an old adage that property doubles every 10 years, right? And that was broadly kind of true. And then it was sort of 7 years, and then it was property doubles every 7 years. Then it was, and it kind of floats around a little bit. But what has changed is information, and what has changed is technology. So if you go back, in fact, I remember my grandmother telling me a story about when she was a kid, and she grew up in England. She grew up in near Manchester, and her brother or cousin or something like that, he was a really talented actor, performer, and he got an opportunity to perform or to become an actor he had to move to the next village, right? The next village. And his parents forbade it because they would never see him again by going to the next village, right? Just by going to the next village, they're like, "No, too far away. We'll never see you again. You'll fall off the edge of the earth," basically. Now, and I also remember hearing my uncle back in the, 70s, something like that. He went and traveled through Egypt and everything like that. And there was no way to communicate with him. You send a letter and it takes 6 months for the letter to get there. you go back to the year 2000 and, technology still hadn't really proliferated. If you lived in Melbourne and you wanted to invest outside of Melbourne, how would you even know where to invest? And even if you had somehow gotten some idea that, let's say you wanted to invest in Dubbo, how would you have done that? I don't think I can't remember when realestate.com.au kicked off, but I don't think it was around in the year 2000, or it would have been pretty early stages. So your ability to even, you would have had to drive to Dubbo, go speak to a real estate agent, see what listings are available. You wouldn't know. And then how would you even form it? How would you do that? Right. So the impediment was significant. Now, what's happened, even when we very first started Dashdot in 2019, the idea of borderless investing was such a foreign concept. We were introducing this idea to a lot of people, like, hey, did you know that you can invest outside of your own backyard? It was crazy to people. They were like, what? No, you need to invest. It needs to be close enough for me to be able to drive to it. I need to be able to see it. I need to be able to touch it. That paradigm has changed. Now, why has that paradigm changed? That paradigm has changed because of technology. Because through technology, we can get better information at better quality and higher fidelity and higher speed about different locations. And I don't just mean like picking suburbs. I also mean for things like due diligence. I mean things like flood zone mappings that are now digital and online, so you can check the flood zone of a property. Satellite imagery, so you can see, okay, how close is it to major power lines and all this kind of stuff. Digital topography, so you can get an understanding of the slope of a property. It could be thousands of kilometers away, and you can still understand the topography and the light patterns and the sun pattern. All of these things exist. You can connect with local professionals to help you to do inspections and all this kind of stuff. All of the things that you used to not be able to do without going to a council office or going to visit a property yourself, you can do. You can absolutely do it all now, and you can do it digitally. So what that has allowed, that's allowed an expansion of capital exposure across the country. Because if you could only ever do that locally, then your capital movement would be restricted locally. Yep. So there is more investment capital moving more freely and faster throughout the real estate market in Australia than there used to be, because there's more access to information and it's much easier to move your capital. It's much easier to target different markets. So that is speeding up the transition of capital between different markets. In addition to that, more people are able to work from home. There's more opportunity to work remotely, all of that kind of stuff, which has meant that there's less need to be proximal to major work centers. So that's why people are moving out of places like Sydney and Melbourne. They can move further away. Even if they need to commute in 1 or 2 days a week, they can still move further out of the city and do the 1 or 2 days a week to commute in and work from home the rest of the time. Or they can work fully remote. So there are more people, more homeowners, not just investors. There are more homeowners actually moving out to more regional locations. In addition to that, there's affordability. So people can no longer afford the city life, right? So a lot of people are actually choosing to find places where they can afford to live and then working out how to find a career there. So they might actually decide, okay, we're going to move to, I don't know, somewhere in Queensland or maybe somewhere in regional Victoria because we can afford that and I'll find a job there. So rather than saying, okay, I'm currently a town planner and I have a job in the middle of the CBD in Melbourne, they might go and move to Bendigo and then work out how to get a job there rather than trying to work out how to get the job in Melbourne. They might actually just make that decision. And so that is causing more migration, both inter and intrastate, to more affordable locations. And so all of that is combining to increase the speed of capital movement throughout the real estate market. Now, since 2020, that has accelerated because that's accelerated because of the increased speed of interest rate changes since 2020. So, or actually since before then. So the speed at which the interest rates crashed to zero and then went back up and now they're starting to come down again, that has also impacted credit cycles and the kind of expansion and contraction of credit availability through different markets, which has forced more vacuums to appear within the space, which has forced more opportunity for capital to flow in and out of different markets. So there's a real shift in the speed at which capital is moving between markets, but it's driven both by investor demand and organic demand. And that's fundamentally because of the access to information and the ease to move capital between markets. Now, what I would say is really interesting about this is that necessarily that increases volatility. Now, volatility is not a bad thing. In fact, if you have low volatility, you typically get lower overall returns.
Mm-hmm.
If you have higher volatility, you typically get higher overall return or higher average returns. That is not absolutely true. And by the way, that does not mean that risk always equals reward. But also volatility is not risk, it's just price movement. Now, one of the things about property, though, one of the things that we've observed is that it has an upward bias to volatility. So the capital is moving into markets faster, which is causing prices to move quicker in those markets. It's causing shorter cycles, but the prices don't crash. They don't go up and then crash down. They go up, they drift sideways, and then they go up again. And so you have upward biased volatility, which is really interesting because other assets that exhibit the same characteristics are things like Bitcoin, even though it's had historically very large drawdowns, those drawdowns have always been to a higher floor. So it's had upward bias volatility. Technology equities, Amazon, stuff like that, they've been quite volatile, but they've always had upward biased volatility as well. And so real estate, because of the increase, and you got to remember the reason that those assets, by the way, are more volatile, liquid assets are more volatile, is because people can trade them faster and there's more access to information. And so there's more price information more frequently. And so real estate is moving along a curve of that, where there's more information available more frequently. People are able to move their capital faster, all of that kind of stuff. And that's increasing the volatility and shortening the cycles of those markets, which is good, by the way. Some people might disagree with me that it's good. But what that means is, because it's upward biased volatility and because of the structural underpinnings of the market, tremendous amount of demand and a tremendous lack of supply, a market may accelerate and then stall, but it's not going to stall for a very long period of time. We used to look at markets and see sometimes they'd stalled and stagnated for, say, 12 to 14 years, whereas now it could be 3 years. And so you might see a big price rise, you might get a rocket ship move, then it might stagnate for a couple of years, and then it'll have another rocket ship move. And so it's actually easier to capture better gains without having to be like, shit, am I going to be stuck in a market that's going to be dead for the next 7 to 10 years? The likelihood of that is less. And so it actually kind of, I think actually is better for investors because of the environment we're in. Now, that being said, not all markets are equal. And so, for example, we won't get to the Sydney topic today, but price to income ratios really matter, or debt to income ratios really matter. So relative local affordability. And so capital is going to continue to move between these different markets where there's a combination of jobs, lifestyle, and relative local affordability. So I think we'll see that as a kind of a core driver. And I discussed a while ago now that I expect that we're going to see a rolling boom, and it's going to be much more like popcorn popping in a pan, where you see like this location is going to boom, then another one will boom, then another one will boom, then another one will boom. And those cycles are going to be shorter until we find more of a general price equilibrium across kind of core markets across the country. So yeah, thoughts?
Yeah. Do you think we're, because of the increased volatility, do you think we're potentially at risk of investors thinking property is more tradable than it used to be?
Well, so
I guess they already do.
Yeah, I think the interesting word you used in there is risk. Do we think we're at risk of that? Well, I don't think it's a risk. I think we are moving into a much more trading kind of environment, but I don't think that's a bad thing either. I think that people who think it's a bad thing have just got a pre-formed opinion that property should be slow, boring, and you should hold it for 30 years. You don't need to do that, actually.
Yeah.
You can, if you're a capital allocator and you trying to find the best place to put your money, then yeah, you probably should be thinking about trading. Obviously, taking into consideration all of the purchasing and exiting costs, or the entry and exit costs of property. But I think that is happening quite a lot more. I've seen that amongst our clients. I've seen that amongst clients of ours who once said, we will never be traders of property, now going, okay, actually, let's sell all of my properties and then go buy more in all of these other locations. So I think that it's a natural progression of the market evolution, and that comes down to access to information. If you think about stocks trade what is it, like 7 hours a day, 5 days a week, or whatever, right? So they're not trading all the time. crypto trades 24/7. So if on a Saturday there's a military strike in the Middle East, then the crypto markets will react instantaneously because people have got that liquidity, and people got access to that information, and they can react to that information instantaneously. Can't do that with the stock market, but you can see what can happen in the crypto market on a Saturday, and then go, okay, now I'm pretty sure on a Monday when the stock market opens, something similar is going to happen, right? And you can do that, and so as we get access to more information, and as our capital is easier to move, necessarily we're going to see bigger price movements. But the thing to remember is that it's upward bias volatility. I think that's a key. I don't think there's a problem with trading assets. By the same token, you could hold on to an asset and not be concerned about concerned about holding an asset through a big dead period. It used to be a big concern. You'd buy a property, it might go up in value, but then you might have 10 years of price stagnation or some price decline before it goes off again. But if that's now reduced to 3 to 5 years, then the downside risk or the opportunity cost risk is also diminished as well. So that actually creates a better environment where you don't need to be as fearful of timing. Obviously, you still want to get in early, but let's just say that you bought in the fourth quarter of a growth cycle in a certain suburb. You got a bit of growth, but not a ton. And then you're like, oh, so you could probably just hang on to it for a few years and then catch all 4 quarters of the growth of the next cycle. Now, this is not an absolutism. This does not mean that all property markets are going to do this all equally and evenly. In fact, the concentration of this activity is going to be centered around locations which can provide the optimal combination of jobs, lifestyle, and relative local affordability. I'll use the Latrobe Valley as a great example, partly because we were just down there and because that's where my parents live and that's where I'm from. In Latrobe Valley, there's a lot of people going, oh my God, Latrobe Valley is awesome. We should buy there. We're going to go buy in Morwell. Right? Morwell's dead, right? Morwell is a dying, sick town. No offense if you live in Morwell. My grandma lived there, I don't hate the town. I'm just saying the practical reality. And Maui is quite similar, right? The economic opportunities are diminishing. The lifestyle opportunities are not there. Like, it's not that good. Traralgon is a great opportunity, right? To buy. Now, so somewhere like Traralgon may experience these shorter, more upward bias volatile cycles, which it actually is doing, because it wasn't that long ago that Traralgon came off the boil and now it's back on the boil. A little kind of secret giveaway there for anyone who is picking up on that. But Morwell is not doing the same thing, or shouldn't do the same thing, or it's going to be a much weaker kind of situation. And so not all suburbs are going to follow this path, but this kind of price action activity is going to be specifically centered around locations which can provide the optimal combination of jobs, lifestyle, and relative local affordability. Locations which are weaker in those 3 key domains will have less price appreciation, less volatility. Place like Sydney is probably going to continue to grind up slowly over time, but you're probably not going to see the big spikes and big booms. So,
yeah, I'll just pull up a question from Jeremy just quickly because it's relevant. Will inner city affluent suburbs property prices underperform based on metro to regional migration, or will increased liquidity and suburb desirability cause inner city suburbs to outperform?
So I think it depends on the price bracket. Because there's a point at which people are not getting mortgages to buy their properties, right? So if you look at Sydney, people buying $10 million homes are not buying. They're not using mortgages. They're not doing a 90% LVR loan on a $10 million property. They're not doing that, right? So what you tend to find is that above a certain price threshold, prices will continue to rise based on the fact that there are a lot more people getting a lot wealthier and they're prepared to pay a lot more money. So in the kind of like upper tier, upper price points, you're more likely to see consistent price growth, because what's happening is the Cantillon effect. The people that are closest to the money printer that are getting wealthier faster can spend more money on buying more expensive things that are separated from the credit creation cycle. If you step down one tier and go, what is the maximum threshold that people who are using debt, where can they afford to buy to? It's in the sort of $1 to $2 million price point, right? Or roughly 1.5 million. And so what you'll tend to find is that in that price point where people are banging up on the ceiling of debt to income ratios, which is most of Sydney, that's where you're going to see prices more subdued. So if we were to take an example, and we had a whole question on this, but maybe we'll turn it into a whole episode. If we were to take an example of Sydney, the median property price in Sydney is, let me just get some more numbers here. The median property price in Sydney is about median dwelling price about 1.22 million, right? So the average income is about 140. Average household income is about $140,000, which means the median dwelling price is 8.7 times the average household income, which means that there's not a really, people have got to earn more money in order for the prices to go up, and wages are not growing very fast. So the likelihood that those prices are going to go up in lockstep with how wages are going to grow, because people can't get access to the debt otherwise. If you go to a market where, say, house prices are 5 times the average household income, then there's a lot more headroom for those prices to grow before they start to tap out people's ability to actually borrow to be able to afford them. So I think it does depend on the suburbs and whether people are buying using debt or whether people are buying using cash. I think it's a very, very very important thing. Now, one thing about capital cities and one thing about migration is that, how do I put this? There is a trend that migrant families will come together to buy a more expensive property collectively, and then collectively move into that one property in a way that probably Australian local families might not.
Yeah.
And that creates demand in that segment as well, which also continues to support capital city markets. So the question is, will inner city affluent suburbs property prices underperform based on metro to regional migration, or will increased liquidity and suburb desirability cause inner city suburbs to outperform? The answer is relative local affordability. And it's a combination of jobs, lifestyle, and relative local affordability. So I think that regional markets broadly are going to perform better than capital markets broadly, because there's more affordability and people can afford to buy the properties there. That doesn't mean that capital city markets that every capital city suburb is going to underperform. In fact, we've actively bought in Adelaide and Perth, Brisbane, and currently Melbourne as well. Some parts of Melbourne do have that optimal combination of relative local affordability still available to them. But I think in a generalized sense, we need to recognize that markets where the median price is north of $1 million makes it less affordable for people to get into those markets, which means that there's less structural demand, which means there's less upward pressure on prices.
Mm-hmm.
Sweet.
Perfect. Sweet. Cool.
Awesome. Okay, cool. We are at time. So guys, let me know if you thought that was useful. Hopefully that was, we covered a bit of ground there. Hopefully it was good, valuable, useful information. If you have any follow-up questions to this, if you guys want to pick apart more, jump into the community. Chuck a post in the community. Let's expand and let's explore. There's lots of good stuff in there. Anything else? Go on.
Yeah, if you don't want to jump into the community for whatever reason, just so you know, it's free and it's basically just like create a login and then you're in there. So it's very simple. It's a good time. Again, all of the stuff that comes up throughout the week, any news stories that we think are interesting, we're sharing those as well as if you come across something interesting and you want like the community's insights on what we think is going on here, it's a really great resource. But if you don't want to join and you have another question that we didn't cover or just comes to mind as you're watching this, chuck a comment on YouTube and we will get back to you there as well. Yeah, I think that's all I had to say.
That's it.
Great.
I think that's it. All right, guys, we will see you next Friday. Bye for now.
See you next week. Bye.